Inventory valuation indistinguishable goods. In this lesson, we're going to look at the accounting treatment of indistinguishable goods, and in particular the problems that arise when trying to determine inventory valuations and hence cost of sales of indistinguishable goods. We'll look at three different methods, FIFO, LIFO, and AVCO, that could, in principle, be used to determine inventory valuations for indistinguishable goods. We'll see that one of these, LIFO, is permitted in the US, where it gives certain types of companies, including large oil companies such as ExxonMobil, a substantial tax break, but is banned under IFRS. And we'll also look at some of the accounting and reporting issues that arise when applying LIFO and help to explain why the method is prohibited under IFRS. Session aims. So formally, in this session, you will learn about the problems that arise trying to determine inventory valuations and hence cost of sales of indistinguishable goods, learn about three different inventory valuation methods, and explore key areas of difference between US GAAP and IFRS. And intended learning outcomes, as usual. Goods can be classified as being either identifiable or indistinguishable. We've looked at identifiable products. Many products have an identifiable characteristic, and many such items can be tracked through serial numbers or model codes. And the costs embedded in each item sold can be readily tracked. We looked at this last lesson under full costing. Indistinguishable products comprise individual items that cannot be told apart. And some goods are indistinguishable in nature. Examples of these are commodities such as oil, gas, coal, steel, copper, industrial components, some agricultural products. It will be very difficult and in most cases impossible to track embedded costs in each product sold. There are three possible ways which we could value this sort of inventory. We could value it on the basis of the most recent prices that have been paid for it. We could value it on the basis of the oldest prices that were paid, or we could value it on some sort of average cost. I'm going to use an example of a trader buying shares to illustrate the application of these different accounting methods. So got a trader, an investor who buys 1,000 shares each year for 5 years. In 2014, bought 1,000 shares when the price was $20. In 2015, another 1,000 when the price has increased to $30. 2016, another 1,000 at $40. And 2017, another 1,000 at $50. 2018, another 1,000 at $60. Obviously picked a good share here, as it keeps appreciating in price. The total cost of the 5,000 shares that the trader bought is $200,000, and that gives an average cost per share of $40. So that's 200,000 divided by 5,000. There will be a central computerized register which has a record of how many shares the investor owns. The investor separately will keep a record of the purchase history, but there are no separate certificates for each block of shares which has been bought. These shares are indistinguishable in nature. We cannot tell if the investor sells one of these shares which one has been sold in terms of the ones that have been bought. So in 2019, the price has appreciated to $90, and the investor decides to sell 1,000 shares. So selling 1,000 shares at $90, ignoring transaction costs, they'll receive $90,000 in cash from the sale. The central computerized register will be adjusted to reflect the sales, to reflect the smaller number of shares that the investor owns. Now, the investor has clearly made a profit, but the investor has to decide what purchase price to use for reporting profit on the sale. There's no way to tell whether the investor is selling shares that were bought in 2014 at the cost of $20 or those bought in 2000 at the cost of $60. And there are three possible choices. You can use the cost of the older shares that were bought, and this method is called FIFO, or first in, first out, the first one's bought and the first one sold, or the cost of the most recent shares that the trader bought, LIFO, or last in, first out, the last being the most recent shares that were bought, the first ones out of inventory, or an average cost of all of the shares that were bought. Whichever method the trader uses for cost of sales will determine the basis on which the remaining shares will be valued, and hence the inventory valuation method. So let's go through each of these individually. So we'll start with first in, first out. So the first relates to the earlier shares that were bought. So here's our historic purchases. We've got we're going to use the price of the older stock. It's not actually the physical shares that were bought first that we're selling, but we're going to use the price of the first ones that were bought, the oldest ones. And the price of the oldest ones is $20. So revenue of $90,000, and our cost of sales in effect is 1,000 at 20 is $20,000. So the reported profit, if we use FIFO, will be $70,000. If we look at what is left, the cost of the remaining shares is $180,000, and the average cost of the shares left is $45, which is weighted towards the most recently acquired shares. Prior to the sale, the average cost was $40. Now it's $45, which is closer to the $90 of the current market price. Let's look at LIFO, last in, first out. So the last refers to the most recent shares that have been acquired. So we'll start with the historic purchases, and we're going to use the price of the most recently bought, the last ones bought, as the cost of sales. So our revenue is still $90,000, but now we're using a cost per share sold of $60. So our cost of sales is $60,000. Taken away from the revenue of $90,000 gives us a reported profit of $30,000. And what is left in inventory, the cost of the remaining shares is $140,000. The average cost of the shares left is $35, compared to $40 before the sale, so it's weighted more towards the price of the oldest shares. And finally, we'll look at average cost. So we'll start off with the historic purchases. The average cost of the stock is the purchase cost, which is total purchase cost of $200,000, divided the number of shares, which is 5,000, is $40. So our cost of sales is 1,000 times 40 is $40,000, and our reported profit is $50,000. Between that under LIFO and that of FIFO, and the cost of the remaining shares is 4,000 shares at $40 each is $160,000, and the average cost of the shares is of $40 is the same as the value that's used in cost of sales. Let's look at the tax implications of using LIFO or FIFO. So LIFO is not permitted under IFRS for reasons that we will explore later, but is allowed in the US. And LIFO is permitted in the US for tax purposes. If companies use it for tax purposes, they must also use it for financial reporting profit purposes. Let's start by looking at tax and FIFO. So under FIFO, the profit from the sale is $70,000. And if we assume a tax rate of 30% on that profit, the tax at 30% is $21,000. So profit after tax is $49,000. But if we actually look at the cash from the sale itself, we've got the $90,000 from the sale, less a current tax liability of $21,000. So the net cash from the sale under FIFO is $69,000. Now, if we look under LIFO, the reported profit is much lower at $30,000. However, that lower profit means that the tax charge is $9,000 compared to $21,000, so significantly less. Profit after tax, reported profit is much lower. But the most important thing is that the cash from the sale is $81,000. That's $90,000 from the sale, less $9,000 from the tax, is significantly higher than the cash from the sale under FIFO. Now, I can buy myself goods with cash, but I cannot buy anything with profit. So I am better to opt for LIFO if I have the choice to minimize my current tax liability and to maximize the amount of cash that I get from the sale. And a quick recap of the cost of sales equation. So cost of sales is worked out using the following equation. So cost of goods sold from inventory equals inventory value at the end of the period plus the cost of additions minus the value of the inventory at the start of the period. Let's go through some examples of the application of inventory valuation methods. So, UK trading company, T Limited, started June with 10,000 units of a component at a per unit cost of £0.4, so a cost of £4,000. It bought 140,000 units of the component during the month and sold 100,000 units at the end of the month, leaving 50,000 in inventory. So total number of units bought 140, total cost of the units was £109,000. So we'll start under FIFO. So under FIFO, the first in are the first out. So the first ones bought are the older stock. So they will go through cost of sales, and the ones that are left are the ones that have been bought most recently. So the remaining 50,000 units left in stock after the sale of 100,000 are the most recent bought. And if we go back through the purchase history, we can account for that by 30,000 units at £1 each from 26th of June, so that's £30,000, plus 20,000 units at 80 pence, giving £16,000, which gives year-end inventory valuation of £46,000. And then we can calculate cost of sales as follows. So the opening inventory was £4,000, plus £109,000, which is the cost of additions, minus the closing inventory that we've just calculated was $46,000. So cost of sales under FIFO is £67,000. And we will repeat this under LIFO. So last in, first out, the last ones are the most recently bought stock. Right? So we're going to use the cost of most recently bought stock as cost of sales, which means that what will be left in inventory under LIFO will be the oldest costs. So the remaining 50,000 units left in stock are the oldest ones. So the ones that we started the month with, which is 10,000 units at 40 pence each, £4,000, and then 20,000 from June the 4th at 50 pence each, giving 10,000, and then the remaining 20,000 at 75 pence, giving 15,000. Add those three up together, that gives a year-end inventory valuation of £29,000. And then we apply the cost of sales equation. So opening inventory is £4,000, plus additions of £109,000, less closing inventory that we just calculated, £29,000. Cost of sales is £84,000. And finally, under AVCO, if we work out the average cost, so we started with £4,000, cost of additions £109,000, total number of units £150,000. So the average cost per unit is £0.7533. So our closing inventory 50,000 units at £0.7533, 37,667, and that gives cost of sales of opening inventory of 4,000 plus cost of additions 109,000 minus the just calculated closing inventory of 37,667 gives cost of sales of 75,333, which is between that of LIFO and FIFO. Let's just explore inventory valuation versus replacement cost. The difference between the value of the inventory in the statement of financial position under LIFO and its replacement cost is sometimes called the LIFO reserve. And we can see what this is. So prices remain at £1. The replacement cost of the 50,000 units in stock would be £50,000. And if we compare that to the inventory under valuation under LIFO of £29,000, this is considerably lower than the replacement cost. The difference between the inventory valuation and replacement cost of LIFO reserve would be £21,000, so £50,000 minus £29,000. And by way of comparison, under FIFO, the closing inventory value was 46,000, which is the closest to replacement cost of the three methods. Now, confusingly, sometimes the difference between the inventory valuation under LIFO and under FIFO is called the LIFO reserve. Let's visit net residual value. So net residual value is related to the accounting for a fallen inventory's worth, and it is necessary to reflect any permanent reduction in the worth of the stock. And this might be due to a change in the condition of the goods themselves, for example, flood damage or other damage requiring remedial work to make it saleable, or it could be due to a change in demand, for example, fashion fad, meaning that prices people are willing to pay for the end goods has fallen. So it could be due to changes in the condition of the goods or change in demand. either of these, management has to check whether the current book value versus the net residual value. And the net residual value here is defined as follows. So net residual value is equal to the expected selling price of the finished inventory minus the cost to completion. And if the current book value is higher than that of its net residual value, management are required to lower the book value to that of the net residual value. And that results in an inventory loss, but effectively that will be taken through the income statement as a higher cost of sales. However, if the inventory's book value is already lower than net residual value, then the value in the statement of financial position is left unchanged. There's no write-up in value. So just a summary. So LIFO, cost of sales reflects the cost of the most recent additions. Inventory valuation reflects the oldest, most out-of-date costs. And the value for equity is understated when current prices are greater than historic prices. FIFO, by way of contrast, cost of sales reflects the cost of the oldest additions, and the inventory valuation reflects better market replacement cost. And the equity better reflects current inventory prices. And if we look at the impact on cost of sales and profits of changing input prices or costs, if prices are flat, there should be no difference between cost of sales and hence profits for the two methods. If prices are rising, the cost of sales under LIFO will be higher and profits lower than under FIFO. Under FIFO, the firm is taking the older, cheaper stock through cost of sales, while under LIFO, the older stock remains in inventory. On the other hand, if prices are falling, cost of sales under LIFO will be lower and profits higher than under FIFO. Under FIFO, it's taking the older, more expensive stock through the cost of sales. Let's just finish by looking at some issues with LIFO, which help to explain why its use is prohibited under IFRS. It doesn't reflect business practices. Businesses sell their oldest inventory first. As stock comes in, they want to get rid of their oldest stock before they start selling their most recent stock. And LIFO is assuming the opposite, which is that they hold on to their older stock and they sell their most recent stock. And in effect, under LIFO, effectively for a firm which doesn't take its inventory down to zero, part of the firm's inventory is never sold. LIFO for most commodities have experienced price inflation over the past 30, 40 years and have resulted in inventory valuations which are below replacement cost. And that in turn has led to understated book values at firms with a large amount of industrial commodities with prices on the balance sheet reflecting prices from the 70s. It makes investment comparison harder. If some firms are using LIFO and some firms are reporting FIFO, so international oil companies are typically reporting under IFRS, while US oil companies are reporting typically using LIFO. The IFRS oil companies will be using FIFO. It makes it harder for international comparisons. And the ultimate goal of the US is convergence to the IFRS, and LIFO is prohibited under IFRS, so this remains an obstacle towards convergence. And there is some academic evidence that incentivize inefficient inventory management. Firms keep higher stocks than they need to, simply for the tax benefit that they do from holding excess inventory. And overall, that's actually inefficient for the economy. And it's unfair versus other industries. Other industries have made profits from inflation, and those profits have in turn been taxed. And in effect, these companies which are trading in indistinguishable inventory have made the profits on these from inflation. They just haven't been taxed on them. So in this lesson, we've looked at problems that arise trying to determine inventory valuations and hence cost of goods and sales of indistinguishable goods. We've looked at these three different inventory valuation methods: LIFO, FIFO, and AVCO, and explored key areas of difference between US GAAP and IFRS.